had mentioned before, about the global bust, and you definitely have been talking about it for a while, at least since you and I have connected. As the timeline for it shifts, is there a conditional environment that would lead you to no longer believe that the bust is on the horizon?
Yeah, it's not really time driven. I mean, what I've said
Right.
all along is when this cycle ends, it will end in a global bust. A global bust is something we haven't seen in 90 years. So the fact that it stretches and goes a few years beyond in the scheme of 90 years, it's something that rare. It's just not going to be a precise point in time, and it's not. There's no deadline on it. There's no what could happen maybe is if the Trump administration's policies really prove so successful that all that money coming in from overseas, investment in this country, getting tariffs to kind of level the playing field in the trade arena. If all those things offset what I think is a coming recession that morphs into a bust, then that's what would change my mind, or that's what would shift the reality of what we get. But I don't have any sense that that's the case yet. I really believe that we are, as I say, it's the huge leverage far beyond 2008 9, far beyond anything we've ever seen in the world before in terms of 330 trillion in debt, quadrillions in notional value of derivatives. That more than anything else is why I think you get a recession that morphs into something far worse. And then you still have under the surface a lot of fragility. I mean, we can look at the fact that, so-called GDP now estimates are at 3.8% for the fourth quarter. I think we're going to go back and predate this period now and say we started the recession before this. That seems insane if you're talking about close to 4% GDP. But under the surface, there's just, again, it's a have and have not economy. And the have nots are at least 50% of the economy, maybe more, or the population, and they are barely getting by. So we're in a period, I mean, it is the roaring 20s in a lot of ways. We're in a period where we're not far from, in that case, the Great Depression, and yet it's party on, folks. Everything looks great. That is the similarity. I mean, there are a lot of differences, but that is the similarity. And I think that's the way it goes, is when you get these events. We saw it in 2008, right up until, in fact, early September 2008. I can remember distinctly. I was saying hard landing ahead, and financial crisis, and you had all of the street economists, almost all of them, saying no recession in sight, soft landing. And we were a month or less than a month from Lehman Brothers and the ultimate crash. So that is the reality, is that when these things, if it's a financial break, when these things break, they oftentimes come out of nowhere, or at least there's not a lot of pre-warning that everybody sees coming.
It's yeah, those interdependencies are also really interesting, and it leads me to one more question for you. Something that I think is common among a lot of your critics with your idea is the timing element of it. A lot of them say, like, oh, he's been saying this for a long time. But can you dive a little deeper just to explore this difference? Because I understand their lens. Their lens is always like, somebody said this is going to happen by this. It didn't happen, so it is not a thing. Your lens is, I'm talking about literally almost a century long thing. When we're talking about 1 or 2 years in that duration, it's same. So can you talk a little bit about that paradigm and the window that you're playing with?
Yeah, it's two things. It's a misunderstanding of what a cycle call is. So, I get myself into trouble because I'll say this could happen by a certain date, and expect people to understand the difference between could and will. So, but they don't. They hear could and they hear will. This will happen by. I have never in my life, as a forecaster, said this will happen. It's could by with a time frame. And so then, if you explain that, the trader side of them says, "Oh, you're just playing games with us. You're just using semantics. You called this thing and it didn't happen when you said." It's a lot of it is because for the retail public, they've come in without really understanding investing versus trading, or really understanding what they're doing. They're kind of brought up in a whatever they're training. Some have gone to these trading shops, or services or whatever. So they are learning the trading, and others just kind of don't know what investing is. But so part of it is that, and part of it is, yes, this is I mean, we're talking about something that's unprecedented in terms of what we've already seen and what we're going to see. This market, I had somebody the other day saying this has been a normal market. I said, do you realize what the S&P has done from 2020? It's tripled. It's tripled in 5 years, 5.5 years. And you consider that normal. You have no idea what you're talking about. But that's their experience level, is that's all they've seen, I guess. So but the other side of it is, why does it keep stretching, or why can you not pinpoint it? And why is this cycle stretching more than most? Part of that is, again, we tend to underestimate. $5 trillion was pumped into the system in 2020 and 2021. We're in Wall Street, in the markets, we're used to money going into the system. It gets pumped in, and it might impact for the next year or maybe two. When you pump in, we pumped 3.7 trillion into the economy after 2008-9 over the course of 7 or 8 years. We had never pumped 5 trillion in less than 2 years. And that money doesn't all, and along with the pumping of the money from the Fed, along with that came all these programs we had never seen before, to stabilize the bond market, to provide small business loans to the tune of millions of dollars to people, just things to try to stabilize a system that was totally shut down. I mean, we shut the economy down, the worldwide economy down, for a quarter because of the pandemic, the fears of what the pandemic was. So we were willing to do all kinds of things that were unprecedented, that were never done before, in magnitudes never done before. What I think, and I didn't, this is hindsight, because I didn't see it all in foresight, but $5 trillion and all the programs that go with it just don't go through the system in 2 years. They go through it. They've helped keep this thing going for a lot longer, but it's drying up. You can see it in the repo. The Fed's repo has moved down towards
It
zero.
hit some of its lowest levels. Yeah.
So you're seeing it there. You're seeing it in terms of some of the credit numbers are starting to show strain. So it's getting there. But yeah, if you look back from, say, 22 to now, it's 3.5 years. And I thought it would happen a lot faster. But I think it's a lot of it is because of all that. As I say, we went from an $875 billion Fed balance sheet in October of 2022 that was the largest it had ever been from 1913 on, and we've gone from that to 9 trillion in 2021. Now we've backed it off to 6.5 trillion, but we're talking about trillions. We're talking about numbers that are just beyond any of our ability to really get our heads around. When we talk about it and we act like it's normalcy, it's not normalcy. And that in my opinion, is probably in a simplistic way what the bust will be all about. Is You've got the combination of policymakers like Powell saying we're never going to do that again. We're not going to print money like that again. We're not going to support the stock market like that again. We're not going to zero interest rate policy again. I think they are, but they don't know they are, and they're going to be reluctant to do that. So that's going to be a delay. That's at a time when things are falling apart, they're not going to be nearly in the mindset that we got to save the system. We've got to do. They won't know the magnitude that they need, and they're going to be reluctant to do it because they don't want to repeat the mistakes of the last cycle. That all those delays in a very leveraged situation is why things can fall apart. Because I'm sure you hear it. I get a lot. Is oh, Trump won't let that happen, or Powell won't let that happen. I go, this isn't going to happen because they want it to. This isn't going to happen because they aren't trying to stop it. It's just the combination of all the things that have come before lead to this kind of an environment where they're going to be slow to react. The leverage is going to mean you have to be faster to act. The size of the leverage means the magnitude of the leverage means the magnitude of the unwind is going to be huge, and they're doing baby steps. I mean, it just all that put together, whether it happened the first half of next year or later next year or right after the new year, I have no idea. But I think it's coming, and I think it'll come fast when it does.